Good morning, everyone. Firstly, sorry for the delay. We had some minor technical difficulties here, but thank you for being patient with us and joining us today. My name's Juliette Sherbin. I'm the Head of Investor Relations here at Manning Asset Management, and I'm joined today by Josh Manning, the Founder and Portfolio Manager, and Adrian Bentley, our Chief Investment Officer. So we've got a number of existing advisors and clients on the line today, but we do have some fresh names. So thank you for everyone again for joining us. But for those of you who are slightly less familiar with Manning, we run 3 funds, and today we are primarily here to talk to you about the Manning Monthly Income Fund, which is our flagship product. It targets RBA plus 5% net of fees. It has a 7-year track record and has outperformed its target return each year since inception. So Josh and Adrian, we've got a number of topics to talk about today, followed by a brief Q&A at the end. If we don't have time to cover everyone's questions, we will get back to you directly with our answers. But to start us off, I guess, what are the considerations that investors need to be thinking about when they're investing in fixed income at the moment, particularly because of obviously what we're seeing with the RBA cash rate, persistent inflation? We saw those numbers come out yesterday, I think it was. You know, what should advisors be looking at? What do direct investors need to be looking for?
Yeah, sure. So I guess the way we think about it really from a sort of a macro perspective, we really see sort of 3 agents. We see governments, we see the household, and we see businesses. So from a government perspective, primarily talking about sort of the Australian federal government, that's characterised by relatively low debt to GDP compared to global standards. We have a good credit rating globally, and from a monetary policy, RBA cash rates have gone up, which does provide more room for them to lower those RBA cash rates if we sort of hit more challenging times and below the appetite of the government around economic growth. So I guess that's a relatively favourable picture, particularly compared to global peers. If we now look at the household, we have a slide here which just looks at one of the key things which we think is a good barometer for how households are going, and that is the household savings rate. So this is the percentage that households are saving of disposable income. And while that has come down off very, very elevated levels, people are still saving money. It's not negative. That there still is a relatively positive picture there. So I guess that once again says that households at this point in time are still in reasonably good shape. But I guess the key thing that they're heading into, Juliette, is really around high cost of living and the higher RBA cash rates, which are impacting mortgages. So if we just look at that, I guess the picture that we see is that the impact is not homogeneous in terms of impacting all households in the same way. We've got another slide here which comes from a recent CommBank survey that was done in last month. And what we can see here is the percentage reduction in spending on a 12-month basis, so Q1 2023 to Q1 2022, and it's broken down by 5-year cohort. So the younger cohorts are on the top part of the graph, and we can see really that pressure, that household pressure, is being felt by those younger demographics. So whereas some of the older demographics are actually spending substantially more than they were 12 months ago. And we think that's really interesting because all this data is sort of paints somewhat of a picture at a higher level, but you've really got to go down into the detail to sort of understand what some of the implications are. So that's something that we are absolutely thinking about front and center in our investment process. If we just move on then to businesses, so how businesses are tracking, we've got 2 areas that we look at here. So there's many areas we look at, but 2 probably of most relevance today. And one of them is the NAB Business Survey. So that looks at business conditions, which is the top line, which you can see there is very elevated compared to long-term averages. So conditions are quite good for businesses. They're reporting quite positive numbers and so forth, but the business confidence, which is the middle one, is at or below long-term averages. So they're not particularly confident, they're not spending a huge amount in investment and so forth, but despite the conditions being quite favourable. And I think the primary driver of that is around capacity utilization. So that's the bottom left chart there, which is above long-term averages, quite substantially above long-term averages, which is saying to us that, businesses are, they are trading quite well. They're performing, the fundamentals are quite good, even though they are somewhat concerned about the outlook, which is reflected in that business confidence. Another way of looking at it is, to say, what are the sort of problem loans in the economy? How are they performing at the moment? And one really good source is this bank non-performing assets. So this looks at the banks in the Australian market and looks at the percentage of their loans that are not performing. And the far right chart we think is most interesting. So that breaks it down by business loans, personal loans, and mortgages or housing. And you can see they are quite low compared to longer term averages. Yes, we think that they are probably artificially low because of a lot of stimulus and so forth. But right here, right now, those rates are relatively modest. So we do think they will go up, and I think that's an interesting point to talk about. But at the moment, trading quite well. I think the other thing just quickly is, we've got 2.5 million loans in the three funds that we run, and we get data on those loans on a at least monthly basis. So from what we're seeing in those pools, arrears and sort of signs of stress are not elevated. They're not trending high. They're actually quite stable. So we're very cognizant of where we are in the cycle, but right here, right now, those data points are actually showing that it's relatively well performing from a credit perspective at the moment.
I think, Josh, that's a good overlay in terms of what we look at in a macro sense in fashioning the portfolio. I think, Juliet, in terms of what investors should be looking at, I think they should be mindful of there's two ways you can create a return out of the credit markets. One is out of interest rates, and that's like government bond fund, long duration. The other is really through credit. And the Manning Fund, being short duration, is really looking to try and generate that through credit through the cycle. And so what we're trying to do is look through the short-term economic sort of outlook and say, where are the points of stress and what do we need to do in terms of managing the points of weakness? Because at the end of the day, the things we invest in have contracted returns and contracted repayment. We're really interested in, are we going to get the money back and are we going to get the interest rates? So what we can do, the tools we have at our disposal there are really avoiding the sectors, changing the weighting, or putting more structures around where we see the points of stress in the economy. And really that's our approach, to generate return based on a floating rate of return by looking through the cycle of credit risk.
So what's an example of something that we're avoiding at the moment, given the product is designed to be through the cycle, which for everyone watching, we say this term through the cycle, which we mean is obviously through the economic cycle, but from more of a portfolio construction perspective, we're saying that you don't need to take an economic view on what's happening in Australia. That's what we're here to do. So we're not a long duration bond fund manager that, as Adrian mentioned, performs in different market conditions. This is a product that, is designed to be a through the cycle product that can be a staple in investor portfolios, given a variety of economic conditions, which is, what we're paid to do. So
I think Josh's slide about where the spending is changing, is different within the sector, is a great way of answering your question. So it's really saying younger consumers are probably under more stress than the baby boomers and so forth. So you say, what are we avoiding? Well, we're looking at what's the sort of consumer debt product around sort of younger people? Where might those points of stress be around unemployment? What happens there? Unemployment's very low at the moment, but what happens if it goes up? How are they exposed to greater interest rates and so forth? So it's really using that economic data to look at, we would expect to see stress coming through in the consumer sector.
Yep.
And so that's where we're sort of saying, what is the nature of our exposure? What is our asset protection? And just how much of that do we want at this point in time?
Yeah. And just very practically, like the larger the loan, the larger the interest rate hikes have on a, take-home pay perspective. If you've got a $300,000 loan, then, if your 25 basis point increase is manageable for most people. But when you start to have very large loans, very indebted people that all their repayments are going up, that is far more problematic.
Yep.
Now, we don't really target those sectors. We always think they're definitely the more vulnerable sectors, but definitely those sort of younger cohorts who are highly leveraged. I think that's where you're going to start to see some of the stress really be felt. Combined with pullback in property prices, could see some of those, particularly mortgages, come under a bit of pressure in that space.
Don't ruin the next section.
Which is sort of one thing we absolutely are cognizant of avoiding.
Yeah. And what about? I spend a lot of my days, talking about construction finance. What's our view on that relative to? As you just said, everything that's been happening in the economy and what we're looking at in the portfolio, what investors need to be watching through the cycle assets.
Sure. So the Manning Monthly Income Fund has an investment policy statement that's very clear around the sort of thresholds that we have to adhere to around eligible assets for the portfolio. So, for example, as portfolio manager, I can't just put in an investment that isn't approved by the investment committee, or put in an investment that is in a sector that we think is very cyclical. So there's lots of checks and balances, but really there's a very deliberate strategy at that investment committee level to ensure that we're not going to places like construction finance, where in most parts of the cycle, listen, you will get your money back, you will get paid along the way. But there are certain stages in that economic cycle where we think there is heightened risk and heightened chance of capital loss. And that's just not the fund that we're running. We really are trying to be very sort of boring and consistent and just deliver a steady income stream and offer that capital stability through the cycle. And what that means is just buying assets that fit the bill in that regard.
Perfect. I guess now, sort of moving on to the second part of what we wanted to talk about today. We are a diversified fixed income fund manager. We obviously have exposure to property-backed assets. We're not in the game on property prices, etc. But we do get a lot of questions from investors and advisors around what specifically we're looking out for as these borrowers do come off the fixed rate loans, and how we are positioning ourselves. What are we looking out for? What's sort of the term of our investments? People want to know about the housing market.
So I might just start if I can. I think one thing that's really interesting in the press, a lot of people sort of assume everyone's just taken out a mortgage, everyone's just taken out the max LVR, and everyone's fixed rate's going to come off at exactly the same time. But the market is very different to that. There's a whole range of borrowers. Some people borrow for 30 years. Some people are borrowing for a year. Some people want a very high LVR. Others are happy to put a lot more of their own cash into that. So, you need to break the market apart and really understand, well, where are we investing? We're not about high LVRs, highly indebted people. It's really more the shorter dated loans. So typically these mortgages are for 1 to 2 years, so-called bridging loans. And the LVR, is around 60%. So when a person's purchasing a property, say it's $100, a fictional $100, they're putting in $40 plus stamp duty, we're putting in $60. So it's a far different proposition to how a lot of market commentators talk about it. And in that space, we really like that. I mean, it's asset backed. It's typically a very liquid asset. So we're not targeting a rural farm in Western Australia, even though that's a beautiful part of the world. We're really trying to focus on sort of key eastern seaboard states where those assets, should the borrower need to sell them to repay the loan at the end of the 1 or 2 year term, that can happen with relatively robust price stability. And typically the people using these mortgages are typically wealthier people. It's not sort of very young people that don't have a lot of savings. I mean, there's some nice characteristics that we're deliberately targeting in that space from a portfolio construction perspective, a counterparty perspective and a loan perspective that has those sort of credit attributes that means that we believe they will perform through the economic cycle. And over the 7 years, it's proven to be a very strong performing asset for us and given us a lot of stability in returns and also a lot of liquidity. So we think that's attractive.
And I think just to pick up on a couple of points there, We're just over 50% in terms of resi mortgages, so it's very much a diversified portfolio. But it's important to remember that stress at a borrower level doesn't necessarily translate to stress at a lender level. So historically, if you go back very long term, lenders get into trouble in the mortgage market at times of high unemployment with high LVR loans. So as a general thing, if you avoid high LVR loans, you've got something to work with in terms of the property market potentially falling considerably. So at the moment, we've got high unemployment, and we've actually very topical about the shortage of housing at the moment, exacerbated by a lot more sort of immigration. So I think the fundamentals in terms of pricing look reasonably good, but a fundamental tenet is to really sort of look through and say, where might the pockets of trouble be if unemployment does go up and people do get in stress? And that's really those high LVR things. So as Josh said, lower LVR opportunities, non-specialist properties, things that are reasonably sort of liquid. Yeah. And we think that's a really good risk return profile to have. And the key is not to just buy your average mortgage-backed security where there's not much return in it. The key is to do a little bit more bespoke, target the opportunities that we see out there and that we can be agile in structuring.
And then what about certain geographies? Are there certain areas? Obviously, when we're talking about resi mortgage-backed securities, where we're not talking construction finance. We've been quite clear on that. Developer associated loans. But what other things are really excluded when you're looking at
so there's probably about 8 to 10 things that we look at from a very high level around when we're picking these types of assets. Geography is absolutely critical. There are certain parts of the Australian market which through time over different cycles have proven to be more volatile because there is just less liquidity, and sometimes the factors influencing that space have a habit of lifting all boats and then also retreating at the same time. So those types of thoughts, an example is around Gold Coast apartments, very attractive place to holiday, but have proven to sort of be very cyclical in many ways, and therefore that isn't a focus of ours. We really want to stay away from that space and focus on, more established houses, which are far more liquid, and there's many different buyers that want to. So if the holiday makers don't want to buy in Sydney, not many people do, but there's lots of other different types of buyers. So you've got quite a stable market to
low days on market,
exactly,
high liquidity,
exactly. So there's a lot that sort of goes into that at the asset selection level. So many of these considerations, portfolio construction, but on that granular level that we really think about and we do day to day, that's just a sample of some of the thoughts that go into it.
And so you're buying these loans pretty much every day for the portfolio?
Yeah, that's right. We've got a very active loan purchasing program that we run here. There's a number of counterparties that we work with. We're very clear on the assets that we want to purchase in that. So we're only presented with deals that fit that. But even so, we still turn away some because there might be certain attributes. And really my job as a portfolio manager isn't to think, 99 out of 100 times we're not going to lose money on this. It's really to say, given the outlook, given all the things we're looking at, worried about, we're very glass half empty in how we look at the markets. Do we think we can lose money on this? And if I think, there is a scenario where we could, that just doesn't fit the risk appetite of the fund. So that's essentially how we manage it on a daily basis in this mortgage space.
And it's possibly worth mentioning, Josh, what is the fund's track record in this mortgage space? Dollars lost.
Yeah, so we've never lost $1 in mortgages of principal, interest, fees, anything. Just by keeping it conservative, and we're not trying to. We could get a lot higher return. We could get another 1 to 2% if we wanted to, but we just think on that risk return curve, just reaching for yield, you just start to go into places where the percentage likelihood of loss starts to really, balloon. It's not marginally increase. It really does get quite substantial, and just by taking a little bit off the table, just coming in a little bit, the quality of the loans we're buying is just exceptionally good, and that's why we love it. But you need to really be looking right across the market, be thinking about all these things. This is all we do, or this is all I do is just thinking about these types of things and purchasing. And I think if you can get that right, it's an exceptionally good return for investors.
And I guess, in summary, sort of on that point, it's, as I said, at the start of this topic, we're not interested in predicting what's happening with Sydney property prices, but if our house view is that it's a sufficiently low LVR, loan,
and just avoiding the potential issues.
Just avoiding the issues. It's too hard to forecast what's going on. So just think, how bad can it get?
How bad can it get? Yeah.
And just whenever we look at something, how as Josh says, do we think we're going to get a loss out of this? And if we do, then we avoid it.
Yeah.
And so it's like, what's the worst it could be? That sort of governs ultimately everything that we do.
And if that's palatable, then we'll look at it.
Yeah.
But if it's not palatable, then why would we risk our capital or our investors' capital?
No, it makes sense. I guess sort of moving on to probably the final pillar of the webinar. Sorry, everyone, if we're running over time, lots to talk about. Josh, you recently wrote an article for Livewire on sort of the different characteristics around public, i.e. sort of traded fixed income assets versus private. And I think, probably everyone watching will have known that in the last few years, private credit funds have received a lot of attention. There's been a lot more coming to the market, and I think largely because we've seen versus listed counterparts how they've reduced volatility in investor portfolios.
Yeah, I agree. So just on that, I actually think there's a role for both listed or public fixed income asset managers to sit alongside more private markets in many portfolios, and the weighting is based upon largely what an investor's liquidity profile is. A public fixed income or public bond manager, typically you are taking more interest rate duration risk, but you can also access your money far more readily, 1 to 2 days based on the fund that you're looking at. And that's reflective of the assets underneath that typically have an element of liquidity. Whereas a more private market fixed income manager, that's more of a monthly type basis, given they are less liquid instruments. I think what that means though is because public market fixed income managers, they are quoted, they are at the whims of how people are thinking about markets, worried about debt ceilings or not, or equity markets and so forth. There is a lot more price volatility, whereas private, it's far more about the fundamentals of how these assets are performing is what the pricing is based on. And we spend a lot of attention through our external valuation agent in pricing these assets so that if there are issues, then they do change. It's not just it's worth $100 no matter what.
And we actually like the illiquidity premium. So if your investor needs to be understanding, what's their time horizon in investing and what's their liquidity requirement. So if they want to get their money at short notice and that's their purpose, then go for a cash fund. If you want to take a long-term interest rate view, then you need a high degree of liquidity within the fund, because the fund's manager is taking a view on interest rates. If that view changes, they need to liquidate a lot of the portfolio.
Right.
So from our perspective, if we're looking through the cycle, then it's far less necessary for us to have liquidity within the assets. And to some extent, as Josh mentions, the pricing of those assets, if you're taking it through the cycle view, is noise, market sentiment, debt ceilings, things that are unrelated. You look through the GFC, mortgage-backed securities were trading at 60 cents in the dollar, and some of them, and nobody lost a thing. So it was
because they held those,
and the pricing was dictated by liquidity in the market,
right,
not necessarily the quality of the underlying counterpart. So I think from our perspective, we're not afraid of earning the illiquidity premium, because our investor base, we're really targeting people who look through the cycle.
Yeah, that's an interesting perspective, I think. And so, what else should investors be looking at in terms of other considerations, ratings of underlying assets for some of these, public public listed securities?
So they can look at, in sort of public fixed income managers, they do publish credit ratings, and that's because those managers typically rely on external research houses to dictate the credit rating of those assets. We do all that in-house. We believe that's a better, it gives us an edge, gives us a more intimate understanding. We can put bespoke covenants and risk triggers in there to protect our capital more so than what a public deal. I think a big thing that, we have seen more fixed income managers come to the fore. And I think a big thing that we see is that not all of them are equal in terms of their debt market experience. Our investment committee has 100 years of running credit fixed income portfolios for large financial institutions in Australia. And we're seeing an entrance of people that don't have that sort of pedigree. And I think grey hair matters in this space. As Adrian said, it's about avoiding.
Why do you look at me when you say grey hair?
I have got some, Adrian. But yeah, around the table there's a lot of experience, and it's not just saying, oh, this is where I am in the cycle, therefore it's okay. You've got to look back 10, 20, 30, 40 years to understand what have been all the issues, how's the markets changed, what's the regulatory environment, all those types of implications. And it's about being very wise. It's not about getting returns in this space. The returns are easy to target, right? What you really want is someone who can avoid the potholes, the risks, and being a strong risk manager. And I think that's probably the most important thing. Pick it based on the experience of the investment committee and the team. Being cognizant of whether you want sort of more liquid, shorter dated, you want that, you want to put it in and take it out, or you're a bit more through the cycle, set and forget type exposures.
Yeah, perfect. Well, I think that brings us to the end of the presentation today, or the webinar. And we do have some questions that have come through, so we'll probably take a couple of minutes for those.
Sure.
Yeah, and I think if investors have questions, if people have time, we're happy to answer. But obviously, if people have to go, then obviously, thank you. Yeah,
thank you. And this is recorded, so we will be sending out the webinar to all of you. So one question that's come in is, it's been a great credit environment. Arrears have been low. What are your reflections on that, and what does that mean for things going forwards?
What are our reflections? I guess that is a consequence of very cheap, very loose monetary policy. Through the GFC, I think is really where interest rates went low through COVID and so forth. So a fairly unnatural environment in terms of the availability of credit. Interest rates are a little bit back to a more longer term trend where they should be. So we just keep looking at where the stress is going to be. So obviously the RBA is putting up interest rates. They want to slow the economy down. They want to have some small negative growth figures. We shouldn't be afraid of that because there's been such strong growth. So we're looking actively for where the stress is going to come, because it will. It's a matter of making sure the book is positioned and protected, and that we're really on the front foot in identifying where those problems are emanating so that we can fashion the book going forward. Yeah. So we're certainly not seeing the current situation as normal.
Yeah.
And I think just on like a portfolio level, like when we're looking at investments,
that question was from an advisor.
Yeah. So like, when different assets are presented to us, typically people will say, over the last 2 years, this has been the arrears rate, and these are the key aspects. And I almost just put that to the side. It's completely irrelevant. We've had artificially low interest rates, artificially low arrears because of all the stimulus. You can't assess something based on the last 2 years of performance. You've got to look far further back.
Which is when, ironically, a lot of credit fund managers have popped up.
Exactly. So the models in terms of what the stresses we put assets through is far more severe than what everyone is looking at. And I think that's key. So the fact that they go up is more they're going back up towards where we think they should be anyway. And then we stress test that on a multiple basis above that. So, it's just about being very conservative. We keep talking about just avoiding the issues, and that's just one of the things that people need to be cognizant of.
And I think it's worth, just to jump in on the end there, in some sectors, commercial property, for example, we really haven't seen a period of stress for 25 years, right? So you really do have to go back, and we're not really in the commercial property space, but I think it's really important to go back pre-GFC, which is which is 15 years almost. And you have to go back that far to see what is historically what we could expect in more normal circumstances.
And so are some, level of arrears okay?
It's just normal. I mean, in credit markets, there will be arrears. Even banks have arrears. Like it's just part of the sector, and it's how you manage those arrears. It's the cause of those arrears. There's lots to it, but it's normal that somebody misses a repayment, and they might miss it because they've changed bank account, or they might miss it because they've had a life event and they've lost their job, and it's very serious. So it's about understanding all the minutiae, which is critical there. But I don't think arrears are a good barometer of risk.
Right.
You've got to go beneath that, and I think too much people talk about their arrears rates this and the LVR's this, and therefore it's all good. It's not the same. An unsecured business loan arrear is not the same as a arrear on a 30-year mortgage at 60% against good quality borrowers that have just changed their bank account.
Yeah, I think that's a great point, because the question is, you can have arrears. The question for us is, how does that translate into a risk to investor capital?
Yep.
And if you've got asset protection, not that we want it, but you can have an asset defaulting, the security gets realised, and you get your money back. That's why we have asset protection. So we're not saying there's not stuff that goes on within borrower cohorts and stuff. What we're looking at is investor capital protected in that eventuality? And I think, as Josh said, an unsecured business loan is very different from a personal loan where you've got plenty of asset security on a low LVR loan, for example.
Yeah.
So I think you really need to think about stresses in the economy, stresses in sectors. How does that translate back into investor capital?
Yeah.
And that's where we're trying to build the buffers and the protection.
So a question's just come through that's sort of related, which is, what is the fund's exposure to office property? So I'm not sure if that's commercial property.
Yes, so there is some commercial property in the portfolio. We don't have any office exposure. So one thing we really focus on is loan size. We think loan size is not talked about enough. We think it's extremely important. A $50 million loan against a construction finance development, in a bad time, that's very hard to refinance. There's not too many people that want to pick up a $50 million loan. That's just not us. We just don't think that that's where the risk appetite of this fund leads us to. We like smaller loans. So a good example of some of the commercial properties we've done is a small warehouse in a CBD type suburb where, it's 50% LVR. It's not expensive. There's lots of people that want that unit. So it's good for lots of different industries, not specialised. We think that's a good place to be. You don't want the whole fund in there, but there's select assets like that make a lot of sense. So no office property in the fund. And
so this is actually a question for me, sort of related. So obviously commercial property, say in a period of stress like COVID, was possibly not a great place to be. Sort of what.
We were very cautious about that for exactly the reason you said. As it turned out, there was so much government stimulus that companies were getting, JobKeeper and all these sorts of things, that the stresses didn't actually come out. But we took a very conservative view at that point in time. We actually exited some exposure because we were very concerned, and that was before the government stimulus came through. But
how did the exit look?
That happened to be something where we had a liquid exit. We had put back to the lender.
Yeah, and we're typically investing quite short term, 12 months, 18 months, 24 months in some circumstances. So these assets are rolling off all the time. So we can be very dynamic in how we manage the portfolio. And as facts change, we change our view and we change the portfolio. And that means we're more active investing because we're turning the capital over all the time. But the flexibility that gives us, I think, is absolutely crucial.
Yeah. That was obviously a very unexpected period.
Mm-hmm.
So we've probably got time for one more quick question. I'm getting this question a lot, so I'm glad someone's asked it. Has the interest rate cycle peaked? Are you adding duration?
Yeah, so whether it's peaked or hasn't peaked, I don't know if we profess to be the leading sort of mind in that regard. We do think it's obviously elevated. We do think the signs that it is sort of reaching a natural height or a peak. But the fund, we're not making interest rate bets. We're not trying to say, oh, rates are peaked, let's go super long duration, buy really long dated bonds, because we don't want the fund's returns to be based on betting on interest rates. If you want to bet on interest rates, you go into long duration bonds. We're far more about just consistently doing a nice return over the RBA cash rate on a monthly basis and delivering that to investors so that advisors don't have to think, geez, the rate's going up. Oh, no, they're going down. Oh, great, I'll go over here. I'll pull out of here. It's more just we can attract a nice income return for our investors by not adding interest rate risk. So kind of why would you add portfolio risk if it doesn't deliver any sort of additional?
It introduces noise into the portfolio that the valuation of investor capital is at the whim of repricing of those assets with all those other factors that we mentioned. We just want to invest through the cycle, get return on the risk that we're taking and provide a floating rate return that investors can rely on every month, and not really the volatility in their capital value.
Yeah.
And I think that's an important point for people to know.
Yeah, that makes sense. Well, we better wrap it up there. Thank you so much, everyone, for joining us today. As I mentioned, the rest of the questions that came through, we will get back to you directly, and we'll be sending out the recording of this webinar shortly. But thanks again for being patient with us at the beginning, and look forward to answering any questions that you may have as a result of this.
Thanks, everyone.
Thank you.